a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Dividend growth ETFs is the topic of this conversation with our ETF research director, Nina Mishra, who joins me here. There's a lot to talk about when you consider dividend-paying stocks, right?
Right. So dividend-paying stocks are usually very popular with investors. So you get nice current income and you have this capital appreciation potential too.
Mm-hmm.
And when it comes to dividend investing, there are two popular approaches. Either invest in dividend growth stocks that have been increasing their dividends consistently for the past many years, or look at the yield, high yield stocks. Now, I personally like dividend growth stocks and ETFs because these are companies which usually have very strong balance sheets and consistent and growing earnings and cash flows. So that is why they are able to increase their dividends year after year after year. High yield, whereas some sectors like utilities, consumer staples, real estate, they pay high dividends, but at times high yield could be a result of decline in share price.
Sure.
Share price came down, so that is why the dividend yield went up. So if you consider high yielding stocks, look at the reason for the high yield too.
Okay.
So sometimes it could indicate low quality of the stock. So that is why I prefer dividend growth stocks. And over the longer term, these dividend growth companies have produced better risk-adjusted returns than the broader market.
But when you're considering sectors with these types of stocks, all sectors not created equal, right?
Yes. So that's what I mentioned, that utilities, consumer staples, and real estate, those are the sectors that typically pay a high dividend yield. So you need to look at the reason for that high yield. One more thing I wanted to add, that because of all these global growth uncertainties and global monetary easing, a lot of investors have been putting money into bonds, driving their yields lower. And in fact, a couple of weeks back, the 30-year Treasury bond yield fell below the S&P 500's yield because bonds have become so expensive now. So that is why when bonds look expensive, these dividend-paying stocks, and particularly dividend-growing stocks and ETFs, I think they make more sense for income-focused investors.
All right, let's take a look at some of these. Vanguard has the dividend appreciation ETF.
So this holds high-quality companies that have increased their dividends for at least 10 consecutive years. It selects and weights them according to their market capitalization, about 184 holdings as of now, very cheap and very popular with 6 basis points expense ratio and 38 billion in assets under management. Now, if you want to learn more about this ETF, you can go to the quote page on Zacks.com. The dividend yield is 1.72% as of now. You can also go to the external homepage using the link on Zacks.com, and you can look at other details, including top holdings: Microsoft, Visa, Procter & Gamble, Walmart, and Comcast are the top holdings, not surprising. And if you look at sectors, industrials, consumer services, and consumer goods, consumer-focused sectors, and technologies are top sectors in terms of exposure.
Then there's the SPDR S&P Dividend ETF.
The ticker is SDY. This looks at companies which have increased their dividend for at least 20 consecutive years. So it goes back even further. And then it selects those holdings. It has about 112 as of now and weights them according to their yield. Slightly more expensive than the other two that we are discussing today, 35 basis points, but very popular with 19 billion in assets under management. Now, when you look at 20 years of dividend growth, this ETF, of course, will miss some of the technology companies because technology companies did not start paying dividends until last few years back. So if you go to the quote page on Zacks.com, it has a higher dividend yield because of dividend yield weighting, 2.36%. And you can look at top holdings and other details by going to the quote page on the link on quote for by using the link for the external web page. AT&T, AbbVie, International Business Machines, IBM, and Tanger Factory Outlet, which is a REIT, those are the top holdings. Looking at the sector, industrials, consumer staples, financials, utilities, and consumer discretionary. And as I had mentioned, very little technology exposure.
Still a pretty broad range of sectors.
Yes, yes.
All right, and finally, iShares Core Dividend Growth ETF.
The ticker is DGRO. It looks at companies that have been growing their dividends, and it also looks at payout ratio. So payout ratio should not be more than 75% of earnings and should have grown their dividends at least for 5 years. So basically it looks at sustainability of dividend. It is more diversified than the other two with 480 holdings, and it weights according to dividend dollars. This is also very cheap with 8 basis points, pretty popular with 8 billion in assets under management. So again, you can use the, you can go to the quote page, 2.23% is the dividend yield, very nice. And you can also go to the external home page, iShares web page for this ETF, and you can look at other details including the portfolio. Because it goes back 5 years, so that's why you see more technology companies here. Apple, Microsoft, then JP Morgan, Verizon, Chevron. These are the top holdings. Financials 19%, information technology about 16%, then healthcare and industrials are the next two sectors.
All right, and you have put together 2 comparisons, one year to date and one 5-year chart.
Yes, because as I said that these are for long-term focused investors. They produce better risk-adjusted returns over the long term. That is why I included a 5-year chart here. And you can see that the iShares product and the Vanguard product both have done pretty well. And the other one, the Spider product, has performed basically in line with the S&P 500.
And then over the 1-year period?
So this is the year-to-date chart. So as we saw, these have like similar methodology, kind of similar approaches in looking at dividend growth stocks, but then very different sector exposure because of the history, 10 years or 20 years or 5 years. They arrive at different sector exposures. So that is why the difference in performance over the shorter term. WIG, the Vanguard product has done really well this year. It's up about 25%. The iShares product is a little below S&P 500, and the Spider product has slightly underperformed with a 15% return, and that's mainly because of low exposure to technology, because technology is the best performing sector this year.
Sure. Okay. Do you own either of these?
I do not.
All right. More ETF articles and other information in the ETF section of Zacks.com. Use the Funds tab in the top toolbar to help guide you there. And if you want to hear Nina's ETF Spotlight podcast, what you need to do is go to the homepage of Zacks.com, scroll all the way down to the bottom of that page, and click on the word podcast. And it will take you to the most recent podcasts and even some a little ways back that you can listen to. A lot more interesting information that she tackles in those. With Nina, I'm Terry Ruffalo.